Welcome to my market commentary for the final quarter of 2025. What a year we've witnessed for markets. Allow me to address the obvious. Why have we conducted our quarterly reviews a whole month early? Well, there are two reasons for this. Firstly, a lady you may have heard of called Rachel decided to postpone the autumn statement to the 26th of November. Given the media circus of speculation around cuts and rises expected at the budget, we were very concerned we could be issuing the quarterly reviews and making important changes at the very same time we might be needed to possibly help with any financial planning emergencies. Secondly, we've become concerned in recent weeks by the meteoric rise of artificial intelligence, that's AI stock valuations, in the US. Fund managers will often look at the price-to-earnings ratio, or PE, of a particular stock. The higher the PE ratio, the longer it takes to earn back your investment. Ergo, the more expensive the stock. The big AI tech stocks in the US are now trading at insanely high PE ratios. A bit like those tulip bulbs of olden times, it only takes a few investors to lose faith, and the whole asset class could tumble. Now, most fund managers don't believe that a tumble in AI share prices would trigger a global market crash, such as with the banking crisis. We agree with them at this stage. However, we wanted to take time to carefully scan all of our models and to make some adjustments in the more cautious holdings now to hopefully limit any damage to some really fantastic profits if the bubble should burst. Hence, why I'm writing out to you and recording this message a month earlier. Now, we'll stay on track with our reviews, planning to wait until March of 2026 for the next updates, unless something really important should happen before then. So, what happened in the shortened 2-month quarter? Well, global markets continued to enjoy better times. There were some wobbles around Donald's views on China, but the potential for peace in the Middle East and the US Fed cut in interest rates all poured hope into share prices. There's still a massive difference in the trajectory of sustainable stock prices, and old world stocks such as fossil fuels, arms, gold and tobacco, etc. This has certainly made it tough going again for all three of our Thomas & Thomas Proethical portfolios. Interestingly, gold has taken around a 10% hit in the past week or so at the point of recording this message, illustrating our warning in the September podcast that gold is not a safe asset and can kick like an angry mule in terms of volatility. The FTSE 100 LNG tracker continued to grow by around 1.6% over the 2-month period from the last review. Now, 4 of our mainstream model portfolios managed to grow better than this over the same period, with only the most cautious level 1 trailing ever so slightly. All 3 of our Proethical model portfolios lagged behind the FTSE 100 for the reasons I've just described. European markets didn't have a good time, and they didn't really enjoy the party as much over this shortened quarter. Dangerously disruptive politics in France put massive pressure on their government bonds. This dragged on markets at a time when the EU is dealing with punitive US tariffs, Germany is wallowing in contraction, and the whole bloc is looking fearfully eastward. This presents our European fund managers with a very tough challenge, as some really good stocks get sidelined quite wrongly by difficult markets. The really good news for us this quarter was the continued rise in Asian and emerging market funds. We feel quite vindicated by this, as our more adventurous level 4 and 5 mainstream portfolios really struggled for several years against a strong US dollar. The tide turned in the summer of this year, and these funds have been lighting up the more adventurous portfolios. Cautious bond funds also enjoyed a sedate waltz on the dance floor, with UK and US government bonds rising in value. We entered this review with one eye on UK corporate bonds, as we wanted to be certain that they still offer value in a potentially choppier market. But falling interest rates are always going to help the bond funds to chip out a respectable performance. Now, there were some superstar performances from a few funds this quarter, and they popped up in the strangest of places. I look forward to telling you more in your portfolio-specific review next. We're quietly proud of the way our model portfolios have grown, this year. The mainstream portfolios have had it a lot easier and delivered some great results. But we're equally proud of the way the ethical portfolios have collectively continued to meet their stringent screening criteria in an age of such concern for the world. Our pro-ethical clients' good news story this quarter really illustrates one positive impact that investment in this space does. Thank you, Beth, for your brilliant work on this. As ever, we're here with you on this journey. If you need anything at all, please don't hesitate to pick up the phone or just email me. My very best wishes as ever, and I'll speak to you again in the new year.